Big changes are proposed to negative gearing and capital gains tax in Australia, and if you own property, invest in property, or want to buy your first home, this directly affects you. The government has announced major tax reforms starting from the 1st of July 2027, aimed at improving housing affordability and increasing housing supply. Here's the breakdown in simple terms. First, negative gearing. Right now, if your rental property makes a loss, you can use that loss to reduce your taxable income. For example, if your rental earns $25,000 per year but costs you $35,000 to run, that's a $10,000 loss. Currently, that loss can reduce your taxable salary income immediately. Under the new rules from the 1st of July 27, if you buy an established property after the 12th of May 2026, you won't be able to use those losses against your salary anymore. Instead, the losses will be carried forward to offset future rental profits or capital gains when you sell the property. If you already owned your investment property before the 12th of May 2026, you're protected. Your existing negative gearing benefits remain unchanged. There's also a major exception for new builds. If you buy a newly built residential property that genuinely adds to the housing supply, you can still negatively gear it exactly as before. The government is clearly trying to push investors toward funding new housing construction. Now let's talk capital gains tax. Currently, if you hold an asset like property or shares for more than 12 months, you receive a 50% discount on your taxable capital gain. From the 1st of July 2027, that changes. Instead of a flat 50% discount, your purchase price will be indexed for inflation. That means only the real gain above inflation is taxed. So if inflation increases your cost base over time, your taxable gain may be reduced. However, there is another major addition, a minimum 30% tax on capital gains. If your calculated tax on the gain falls below 30%, additional tax may apply to bring it up to that minimum threshold. The good news? Your main home remains exempt from capital gains tax. That part is not changing. So who wins and who loses here? Existing investors are mostly unaffected due to grandfathering rules. Investors buying established properties after May 2026 lose the ability to immediately offset rental losses against salary income. But investors buying new builds will see little change and may still access negative gearing benefits and capital gains tax concessions. These reforms are designed to make established property investing less attractive while encouraging investment into new housing supply. Whether you agree with the policy or not, these changes could significantly impact investment strategies, cash flow, and long-term returns. If you're thinking about buying, investing, or restructuring your portfolio before these rules begin, now is the time to understand how they may affect you. Follow for more breakdowns on property, lending, and finance.